Thank you, Rebecca. And thank you all for coming to our roadshow. I'm certainly really glad to come back. I was in the same roadshow for 2016, so 2 years passed. What's changing? Well, we are here to talk about the outlook for 2018. Now, you see, we are already 2 months into the new year. Well, and the financial market has been on a wild roller coaster ride. You know, it feels like we are going to watch the Disney movie. We bought the ticket for Goldilocks, where everything should be perfect. But all of a sudden, oops, movie changed. It's a Cinderella that we saw the girl has enjoyed the party too much and forgot that the clock is going to strike 12 eventually. So volatility increased a little bit, and many are wondering, what's going to happen next? What shall we do? Well, my advice in this kind of situation, first, get used to it. Because 2018, we are seeing inflation and volatility. They are coming back, and they are here to stay. So get used to it. Second, do not jump into the sentiment cycle when it's not backed up by the fundamentals. You know, sentiment. Market is having a panic. When you saw that, remember, we are long-term investor, and we have a diversified portfolio to protect us. So stay calm, drink your tea, and come to our Vanguard show. And together with you, we are going to discover the underlying forces behind the scene that's shaping up the financial market. And this way, we will be able to see how things evolve in the future and eventually find our answer. Okay? So that is what we're going to do today. Speaking of the force, well, movie change, boys' favorite, Star Wars. Now, after the financial crisis, actually, we are seeing the global economy is in a tug of war between 3 forces. The first force, I would say, is the structural force. Structural force, we talked a lot about that before. Weak demographics, you know, and unfavorable productivity growth. The second one is the secular force. Secular force, that's a post-crisis balance sheet adjustment. Now, the first 2 forces actually are working together to depress the global economy and inflation downward. The third one is the cyclical force. That is unprecedented monetary stimulus after the crisis. And that one is trying really hard to lift up the global growth. For many years after the crisis, we are seeing that the first 2 actually dominated. That's why, for many years, we are getting more and more frustrated and disappointed by weaker than expected growth. However, the interesting part about human nature is that when you get disappointed for too many times, you get used to it. You not only get used to it, you fell in love with it. Because the lower than expected growth and inflation is preventing the central banks from tightening aggressively. And in turn, that justifies the trinity of low interest rate, easy financial conditions, and elevated asset valuation. But the problem is, the market is getting complacent about this Goldilocks situation. Well, behind the scene, the balance of the 3 forces is quietly changing. So this is the biggest risk we highlighted by the end of last year, that the market itself is not prepared to expect the coming back of inflation and volatility, because essentially the market is mistaking the long-term trend for the short-term cycle. So in that case, when you are getting something unexpected, then you are going to see the volatility to rise. So this is what we are trying to say this year, is that, you know, a gentleman in my table was saying that in 2016, I remember you talking about fragile economic recovery. Fragile is probably still the word for this year. But this year, it's not the economy that's fragile. It's the financial market. So in 2018, when you are analyzing the fundamentals, you have to be very careful what is the trend and what is the cycle. We see the long-term trend growth is still low, but hey, we are going to have a cyclical rebound in the economy. The long-term inflation outlook is still subdued, but tightening labor market is going to give you higher wage growth and inflation. Those movements will embolden the central bank to tighten, and that will trigger higher volatility. So this is what we should expect for 2018. Now first, let's talk about the economy. Well, if you come to our Vanguard show before, you'll hear us talking about the structural trend, structural forces many times. I don't want to say, may the force be with you, but this force will be there for a long time and restrain the global economic growth potential. But the good news is that the second force is gradually fading. The post-crisis hangover, right? We are seeing that private sectors in Europe, US, they largely finished their deleveraging, and now they are ready to leverage up. And we are also seeing China make significant progress on the overcapacity reduction. Australia, mining downturn is coming to an end, and many emerging market economies is making significant progress in terms of the external balance after years of painful adjustment. So the fading of the secular force is making the balance of the three forces changing and make the global economy much more responsive to monetary stimulus, and as a result, a cyclical bounce in the global economy is more likely. We are particularly positive about the US economy this year. We expect US to rise 2.5%, higher than its 2% trend growth. In particular, in the US, we are expecting the CapEx cycle to accelerate. We found significant negative correlation between unemployment rate and business investment. Understandable, because when you have labor shortage in the labor market, the business will have to ramp up the investment in new technology, which is less labor intensive. At the same time, US has fiscal stimulus. We estimate that the tax cut is going to add about 0.2 to 0.3 percentage point to the economic growth this year. It's probably not going to add too much for the long-term growth potential, but you know what? For this year, it's going to be a sugar high. We are also quite positive about Europe and Japan. You know, Europe is finally getting into a brighter horizon. All the countries are growing, unemployment rate is falling, and we are seeing that political risk is diminishing. So we expect Europe to rise over 2%. Now that's quite impressive compared to the trend growth of Europe, only 1%. Japan is riding with the global tide. That's why you're seeing the manufacturing sector and export sector is booming. But we are also seeing domestic confidence is high, and Olympics is coming in Tokyo in 2020. And that is going to boost up the domestic demand. So again, we are seeing another year of above trend growth of 1% in Japan, which is still higher than its trend growth of 0.7%. But the picture looks less rosy when we come to this region. We are expecting the Chinese economy to decelerate a little bit, and we are expecting another year of below trend growth in Australia. Now you see, compared to other economies we just mentioned, the difference, other economies, they largely finished their deleveraging cycle and they are ready to leverage up. But in China, the corporate sector, and in Australia, the household sector, you never really had the deleverage over the past decades. So those two sectors are now probably at the peak of the leverage cycle. There is a limit how much the balance sheet can be expanded, especially when the policymakers are concerned about financial stability risk. So in that case, we will either see slower credit growth or outright deleveraging in coming years, and that will restrain the economic growth. But I would say we are not bearish at all. You know, for China, we expect the deceleration to be very modest, from 6.9% last year to 6.5% this year. The downside risk is quite limited because, as we mentioned, one, overcapacity drag is going to be less intense compared to previous years, and also China is rebalancing. Consumption upgrade, and also the booming service sector is going to offset some of the slowdown in the older economy sector. Even for Australia, yes, we are a bit concerned about household consumption, given your record high debt level, given the low wage growth, and also the rising energy bills. But on the other hand, we see the mining downturn is stabilizing, and we are seeing the external backdrop is still very supportive for Australian economy. So we expect Australian economy, the growth to remain in the range of 2 to 2.5%, slightly lower than the 2.7% trend growth, but the chance that the growth comes below 2% is really low. So you would see, overall, the growth picture looks pretty solid. That's why we are saying, come on, this year, it's not the economy that's fragile. But on the other hand, the growth, solid growth picture is hardly a surprise to anybody because we had a good growth last year as well. So the question is, especially for financial market, is that where are we going to see the surprise? Well, I would say inflation would be one. You know, one of the puzzles we had last year is that we had good growth last year, but why the inflation is still falling? We now understand better that inflation, just like growth, is also in a tug-of-war between the structural and cyclical force. There are structural forces such as globalization, technology advancement. They are the long-term deflationary force. We estimate that technology advancement every year will trim off at least 50 basis points from the producer price. That's quite powerful. But on the other hand, we are seeing the tightening labor market is finally driving higher wage growth and inflation. Over 80% of the global economy is already at or below full employment. Phillips curve is not dead, and they could actually steepen when the economy falls below full employment. Understandable. When you have labor shortage, workers will get a stronger bargaining power asking for wage growth. So the risk is most pronounced in the US, again, because US is most advanced in the business cycle. We expect unemployment to fall below 4% this year, wage growth to reach 3%, and core PCE, that is what the Fed is watching, to rise 1.8 to 1.9% this year. But the risk could also emerge elsewhere. You know, Europe, finally, this is the year we are seeing Europe economy is reaching, the labor market will hit the full employment benchmark of 8.5%. Even in Japan, right? The country who suffered so many years of deflation, we are seeing unemployment rate at a 2-decade low, and part-time worker wage is already over 3% growth. So we are also expecting Japan probably reach 1% inflation. Even China, inflation is going to shift from 1.6% last year to around 2.5% this year. The story may be a bit different for Australia, given your below-trend growth, right? The thing is, labor market in Australia is not as strong as it appears to be. Yes, employment surged, and yes, unemployment rate fell rapidly. But on the other hand, if you look into the details, we saw that most of the job gain is part-time. People want to work for full-time. So this is underemployment remains elevated. And this is a hidden slack in the labor market that will continue to restrain the wage growth and inflation. So this year, we are probably going to see that Australian inflation will disappoint again. But to be fair, even for other regions, outside of Australia, when we are expecting, inflation to rise faster, we are not saying that inflation is going to run away. So, particularly because of the structural forces we just mentioned, in fact, if you look at the US, over the past 25 years, 80% of the time, inflation remains well below 2%. So, in other words, we expect inflation surprise in those regions, but we do not expect inflation scare, as some in the market right now is fears. So given that, I would say, but still, you see, inflation surprise could still embolden the central bank to tighten. And even in Australia, where inflation probably is not really a big problem, financial stability will embolden the central bank to tighten. So tightening central bank will eventually lead to rising volatility. As we can see in the history, it's quite normal that volatility will fall when there is easy financial condition, but we also see that volatility will start to rise when central banks start to tighten, especially when the tightening is unexpected. Now you see, Fed has been saying that we're going to hike 3 times this year. And we think they could even hike more if the core PCE hit 2%. And the Fed keeps saying that our terminal rate is 3%, which means they're going to hike 6 times in total by the end of 2019. But the bond market does not believe them. The bond market, even after recent adjustment, is only pricing in less than 3 hikes for this year and 4 in total by end of 2019. So think about this. If we have an inflation surprise in the US, global picture looks good everywhere else, and also in the US, then Fed will be emboldened to press on with its monetary normalization plan. And then the bond market will be again busy to reassess the outlook for interest rate and break-even inflation. That will cause volatility. In addition to the uncertainty about how many hikes, the number of hikes, there is also uncertainty associated with the balance sheet normalization, which we never had any experience before. Well, we try our best. We build our model, and we estimate that the balance sheet normalization in the US probably will drive up the term premium and the long-term yield by 40 to 65 base points. Consider, 1, the rising uncertainty, and 2, the changing supply and demand dynamics. This process should happen in the next 2 or 3 years because the balance sheet normalization is a gradual process. Theoretically, it should be gradual. But as you can see from the market is trying to front load all the moves. So obviously, Fed is leading in terms of the tightening, but we see other central banks follow suit as well. Bank of Canada, Bank of England already hiked. ECB has already slowed their QE purchase. Now, to be fair, we are not expecting ECB or BOJ to hike interest rate this year. But let's say, if growth surprise on the upside, inflation surprise on the upside, and the ECB and BOJ, they will start to talk about the potential hikes maybe later this year, what we call forward guidance. And in that case, the market again will be busy changing, revising the outlook. Another major economy, China. The interesting part is China is also tightening, right? Now, central bank in China didn't really hike the policy rate, but the regulatory overhaul, especially regarding the shadow credit, And also the rapid rise in the market interest rate suggests that China already have the de facto tightening. Now, the growth picture looks solid so far, so that actually emboldened the policymakers in China to focus more on the growth quality rather than the growth rate, which means in 2018, you are going to see the policy continue to focus on 1, financial deleveraging, 2, environmental protection, 3, overcapacity reduction. That actually bodes really well for China's medium-term financial stability and also the growth rebalancing. In fact, if you look at China's credit profile, it stabilized somewhat in 2017 because of the regulatory tightening and a recovery in growth. However, the risk is that policymakers lagging behind the curve and underestimate the negative impact of the regulatory tightening on economic growth. They overkill. In that case, I would say probably investors will be a bit surprised by weaker than expected data from China early this year. So there could be occasional growth scares. But despite that, I would say the chance of hard landing in China is getting lower and lower. You know, to a certain extent, the slowdown in China's growth is engineered by policy. Chinese policymakers may have already increased their tolerance for slower growth, but they are not yet to give up the growth rate at this moment. So in that case, when the growth slows more than expected, policymakers could come back, relax some of the previous tightening, and then they will provide a cushion to the economy. That's why we are expecting the economy only decelerate to 6.5% this year. So this is about the, most of the major economies. I think the situation is a bit tricky for RBA. Because from RBA perspective, yeah, everybody is good, but I'm having a below-trend growth, and inflation is not going to surprise. Shall I cut interest rate to stimulate up the economy and inflation? But on the other hand, as you can see, kind of similar to China, RBA is also having the financial stability concern. You have the household debt that is at record high level. And you have also the housing price pretty elevated. So I would say RBA is going to be in a dilemma. However, recently, we do see that RBA's rhetoric is increasingly focusing on financial stability. So I would say, probably they will still eventually hike, especially when the global yield is rising. But they are not going to be that proactive. So they probably will drag their feet and wait until later this year to hike. In that case, they are not going to be overly aggressive, and it's not going to be too restrictive to the economy. You see, this is our global story. For most part of the world economy, we are having above-trend growth, higher inflation. For Australia, the story is different. We have below-trend growth, still subdued inflation. But you see, the implication on the central bank policy is pretty the same. Either in the name of inflation or in the name of financial stability risk, central banks across the world are moving down the tightening path. Now, let me be clear. We are expecting inflation surprise, but not inflation scare. We are expecting rising financial risk, but not immediate financial crisis. We are expecting the central banks to be tougher, but not yet turning into a killer. Well, that's our baseline scenario. I would say if that scenario is realized, it's pretty good. Right? It's going to be another good year for the financial market because no matter what, fundamentals still solid, and that will continue to support the earnings growth in the corporate sector. But one thing that's very different from 2017 is that we started this year with much higher valuation and started this year with much lower volatility. So given that, I would say even modest inflation surprise or even modest, more hawkish central bank is going to translate into heightened volatility in the financial market. That's why we say financial market is fragile this year. Now, Australian equity appears to be still in the fair value range. However, equity market outside of Australia appears to be stretched in terms of valuation, especially the US equity. You know, we estimate that for the US equity, the chance of a 10% or even larger decline, you know, in any given year in the next 5 years, the chance is 70%, significantly higher than the historical average of 40%. So you see, what happened in the first 2 months of this year is just a mini rehearsal of the full year show. We should expect more volatility down the road. Now, this is for the short term. For the long term, the 10-year outlook for global equity, unfortunately, has further deteriorated compared to our forecast last year, not surprisingly because of the further expansion in valuation. We expect the global equity to give you about 4.5 to 6.5% return on average for the next 10 years. Australian equity gives you slightly higher return, 5 to 7%. Still, that's much less compared to the 9.4% you get for the past 30 years. So this is for the equity market. The key reason for the subdued outlook for the next 10 years is because of a 2.6% contraction in valuation every year going forward. So that is why we are expecting the return to be much lower in coming years. You know, return for non-Australian equity is going to be slightly lower than Australian equity, but do remember, they are in your portfolio and give you the diversification benefit. We have some good news in the fixed income market. The 10-year expected return for the global bond portfolio and also Australian bond portfolio is going to be slightly higher than our forecast last year, given the recent rise in yield. So both Australian bond and global bond portfolio is going to generate 2 to 4% average for the next 10 years. But you see, not everybody is happy with the rise in yield recently because they are creating short-term loss and triggering volatility in the financial market. Now, to us, we believe the recent rise in the long-term rates is justified by the fundamental and also should sustain there even if you just make reasonable conservative assumption about term premium. But we do not expect the long-end yield to run away, at least not on a sustained basis. Because ultimately, long-end yield is more determined by the structural forces, not the cyclical force. The structural forces including the long-term subdued potential growth and the long-term subdued inflation expectation. So given that, we would say the long-end yield is going to be well anchored by those structural forces. We estimate that the 10-year government bond for Australia, the yield should hover around 3%. And we estimate the fair value for the US Treasury, the yield is going to be 2.5 to 3%. That's a fair value range. And in the medium term, it could gradually rise towards 3 to 3.5% when the term premium normalizes. But even that is much lower than what we've seen in the history. Now, the well-anchored long-end yield is causing concern in the market as well about a flattening curve. Because when you are looking at the Fed, they are going to hike 3, 4 times this year. And we know that the Fed hikes is going to move the short-term end rates significantly. While your long end is well anchored, short end rates increase dramatically, and that could cause a flattening curve. Why people are concerned about flattening curve? Because a bear flattening curve could signal an economic recession is coming, especially when it is eventually reversed. Well, that concern is legitimate because, come on, US economy is already 9 years into this business cycle, right? But you know what? We say business cycle does not die of old age. You guys in Australia should know better about that, right? Business cycle, they do die. They die when there is a bubble and there is a trigger. Now, when we look at the US economy, well, I wouldn't see there is like significant bubble that's posing systematic risk. You know, household just finished their deleveraging, corporate sector have very solid balance sheet. But there is indeed a trigger. That is the Fed. The Fed could eventually kill the expansion either when they make a mistake or when they are forced to hike aggressively when inflation just shoot up or run away. I don't really see that as a big risk for 2018. But I would say, you know, we got to be careful later this year and probably in 2019 when, one, unemployment rate fell well below 4%, and two, when the real interest rate right now is still negative, hits 1%. So that is something we got to watch for. But this is for all the short-term volatility. We are long-term investors. We need to understand about it. But let's focus on the long-term return outlook. Well, just as I mentioned, both the global equity market and bond market is going to give you a lower expected return compared to the historical average. Global 60-40, the portfolio, diversified balanced portfolio, is only going to give you, on average, 5.5% return for the next 10 years, compared to 11% we got ever since 1970s, and 8.5% we got ever since 1990s. As you can see, what we are having today, elevated equity valuation, compressed spread, and low interest rate. You know, those are the things that, as a consequence of the great return for the last several years. But they are also going to drive lower return in the future. They basically pull down the efficiency frontier of the expected return to a lower orbit. What's more, the efficiency frontier is also flatter. That means for every unit of risk that you are taking, you are getting less compensated. You are not getting the same return as you did in the past. So this is going to be a very challenging investment environment for the long term. And some are arguing, well, shall we try something new? Let's search for yield. Let's search for return. And hey, you just mentioned that, you know, Australian equity is going to generate a slightly higher return compared to other regions. Let's stay in Australia. Let's have a home bias. Our simulation found that, well, those portfolio is going to give you similar or slightly higher expected return compared to the balanced portfolio. But you know what? They are also going to give you much higher volatility. Because this kind of tools ignores the diversification benefit among different asset classes and eventually leads to inefficient investment portfolio. So this is what we are having today. We do see, for most part of the global economy, growth is going to be solid. We could have some surprise on the inflation. And overall, central banks of the global economy countries, they are going to move down the tightening path. And that is going to trigger volatility in the financial market, especially given the elevated valuation. But for the long term, you know what? Cyclical force will fade. Structural force will come back and dominate again. And that is when we are going to still have the low growth, low inflation, low interest rate, and low asset return. It's challenging. The ultimate solution, I don't think, is some new or fancy investment strategy or tools. What shall we do? My colleague friend will tell you more. As for me, I try to stay in control. I work harder. I spend less. I save more. I control my investment cost. I stay diversified and focus on the long term. So in that case, I can join you, stay calm, drink my tea, and enjoy friends' presentation. Thank you.